We are going to talk about one of my favorite stocks in the market, SoFi. That probably tells you which side of this I'm going to take. But joining me today is Tyler Crowe, who is not as optimistic about certain stocks as I am. Before we dive in, take a minute, check out fool.com/Frankel, the link you see on your screen right now. You can get the top 10 stocks to buy from the Motley Fool, and it's the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. So, Tyler, before we dive in, I take it you're not a SoFi shareholder.
I'm not, and part of the reason I brought this idea up to you is because I've heard you talking about how much you like it, some of our other colleagues, how much you like it, and there's been a lot of reasons why. And so I just kind of went through the exercise. I was like, okay, so if I were to take the other side of it, like, because the stock is down a lot and everyone kind of that I talk to says it's super cheap. And so I started just digging into like, okay, so why would the market think it's cheap? And so I just started putting a case together of why it might not be and why people may be against it. And so I thought it would be a healthy exercise to kind of go through both.
Okay, fair enough. So I'm going to lay out some of the bull case for the time being. I, you mentioned it; it's trading at a 52-week low right now. It's been beaten down. The valuation looks pretty compelling compared to its growth. So just for some numbers, SoFi's trading for about 1.16 times book value right now. That's actually lower than Bank of America is. It trades for 1.76 times tangible book, which is right close to where Bank of America is, much less than a big bank like JP Morgan. And the reason I'm mentioning those is because SoFi is still growing very, very fast. So I think it kind of deserves a little bit of a valuation premium, if anything. Just to kind of throw some of those numbers out there, SoFi started 2021 with 2 million members, meaning customers. It now is over 8 million. The slowest year-over-year growth rate it's posted in a quarter since then is 44%. I know the kind of, the counter argument to that is their customer acquisition cost is very high. They're pretty much giving people free money to join their platform. But if it's sticky, then I'm all for it. The other big thing is that membership growth has largely come from financial products, meaning bank accounts, credit cards, brokerage accounts, as opposed to lending products. So the ratio of financial products to loans has increased dramatically over the past few years. And the reason that is significant is because of that customer acquisition cost I just mentioned. It creates a natural pipeline to cross-sell loans and other products to customers that you don't have to pay people to apply for and get. Kind of, Wells Fargo, Bank of America, JP Morgan Chase, the most success they have with loans is getting their existing customers to apply for a mortgage, apply for a credit card, things like that. So there's the big growth, and then there's a lot of future potential in some very high profit areas. One that I'm particularly excited about, and then I'll be quiet for a minute, is credit cards. SoFi is in the credit card business. They have one credit card product. It's a cashback card. It gives you pretty much 2% cash back on all purchases. Very standard generic type cashback credit card. It's not a standout product. The company has said in recent conference calls that it's in full investment mode on the credit card business, that building out its credit card portfolio is a big part of the future strategy. And for those who follow companies like Capital One that have massive credit card businesses, you know that it can be a big, big profit center if it's done well. SoFi has a history of innovating products. They can make products that kind of stand out from the pack. And I think if they do that, this could be a big deal. The average credit card interest rate right now is about 25%. SoFi's cost of deposits is, 5% or so. Even allowing for a reasonable default rate, there's a lot of margin potential there if they do that well. So that's just one example of something I think they can really still capitalize on. And I hope to see them do that over the next few years. So those are some of the bull cases. So Tyler, what did you find when you dug into it?
So yeah, I'm going to get a little bit into the banking stuff, but I kind of want to do one little quick like myth busting thing, and maybe it goes back to your cost of acquisition thing being very high. But I've heard a lot about like the idea of it being an internet bank, and so like it doesn't have the costs that a normal bank does. It can be cheaper and be more profitable. But just looking at it, its overhead costs as a percent of revenue are higher than every other bank that you compare it to. I think it's SG&A costs to revenue are 56% right now, compared to, like we just said, JP Morgan is 33%, Capital One Financial 36%, Citigroup 38%. So it's on the high side of the cost structure of most banks. And the thing that always kind of started it to I couldn't quite figure it out. And when I got into digging, this is where I kind of arrived at, is like, SoFi Technologies has a high net interest spread or high net interest rate between like the loans that it has on its books, or its interest bearing assets, whether it be student loan refinancing, personal loan refinancing, auto, whatever you want to call it. It's about 10% its assets or yielding assets. On the comparison, it has about 3% on its deposits, which is really high, right? But still, 6% net interest margin is really good for banks. And the thing I couldn't quite figure out is like, how are they that much better that they can generate net interest margins that no other bank can? And that's where I got into its loan profile, right? And if you look at its loan profile, the vast majority of its assets are, like you said, in credit cards, in auto loans, and things like that. It doesn't have a lot of kind of those lower yield but safer assets like mortgages, because those are backed by collateral that actually increases in value. Most credit card loans are uncollateralized. Student loan, there's some repayments, but typically they go into some sort of deferral, something like that. And then automotive is a declining asset. So part of me looks at this and says, so if it wants to continue growing at the rate that it's growing, I kind of looked, to use the comparison, I feel like SoFi has kind of dieted a little bit on the sugar side of a bank, taking those higher interest rate asset yielding sort of things, credit cards, things like that. And to build out a bank over the long term, you can't just subside on sugar, right? You have to actually have some nutrition behind it. And that's where we get to the mortgages. They're going to have a lower rate. But as this company grows, it's going to have to probably have some sort of lower base, less risk collateral or part of its loan book. And if that were to happen, it's naturally going to lower that net interest margin. And that's when it starts to look a little bit more like a regular bank, right? And so what I'm trying to get at here is like, I don't, there's a part of me that says SoFi will be successful on its current trajectory in the event that the economy stays strong. It's very much a directional bet on the economy. People have jobs, people are growing income, spender confidence, things like that. We're not seeing high default rates on auto loans or personal loan refinances, credit cards, things like that. But in a recessionary or a kind of people are reeling in on their credit, SoFi is going to be one of the ones that has pushed the risk profile compared to a lot of other banks. And it would likely see, like you said, some hits with a 6% in interest margin. Yes, it can take that, but at the same time, maybe it has to scale back some of that payments that they're making on their depositors, where they can't give them 3% on their credit cards. And then it's, again, you get back into that role of, well, how fast can you grow if you're not bringing in people with giving them a lot of money, right? So I think as long as the economy is doing well, I think SoFi is going to be fine. But if there's any concern of recessionary environment in the next year or two, I could definitely see SoFi running into problems for those very reasons. And because of that, me just being that slightly more conservative person, I see enough downside from that risk that I don't necessarily feel like buying even at these lower, this lower valuation is the best idea. And so that's like the bear case to me.
Yeah. So just to kind of go over a few kind of quick points. I mentioned the credit card business. You said, no other banks get these kind of net interest margins. And if you look at Capital One, which is a very credit card focused bank and one that doesn't do that well with recessions, its net interest margin is 6.7% right now. So it's JP Morgan and Bank of America are in the 2 to 3% range for comparison. The bulk of SoFi's money comes from personal loans. So these aren't even, and I want to clarify that between that and auto lending, because personal loans have the distinction that they're not asset backed, which kind of goes to Tyler's point that it's a little bit riskier. Auto loans, if the borrower defaults, they can at least go repossess the car. With a personal loan, you're just kind of out the money. So that's kind of arguing against my point, but it's okay. I thought it was worth bringing up. Their student loan portfolio, which is where SoFi started, the yield is very low. It's like 3 to 4%, but their default rate is almost nothing. The student loan default rate in SoFi's portfolio, they only refinance for borrowers who really demonstrate an ability to pay back, where it's a very small percentage of their income. And student loans are not dischargeable in bankruptcy, as we know. So borrowers tend to take those seriously. So those that have a very low default rate but very low income. The mortgage business, I would love to see SoFi build its mortgage business. Now is just not the time to build any kind of mortgage business anywhere. They're not going to.
I would argue against that though, because if you could lock in a bunch of mortgages at 6-7% that are collateralized against real estate, that
It's
if you
fair.
can get that, that's pretty good. Like much better than if we're trying to refinance mortgages down in the 3-4% range, because then your depositor base is eating all of your net income margin.
That's fair. I was more making a point that it's tough to try to build volume right now in the mortgage space rather than the economics of it.
Very fair. Very good point.
When mortgage volume is very low, and companies like SoFi generally don't, I mean, not always, but generally don't focus on origination. They focus on refinance just because it's a lot easier to do as an online business. Think of companies like Guaranteed Rate, Better Mortgage, things like that. Better is the one that I used to refinance my loan a few years ago. And the refinancing industry is just, slow to a crawl right now. That could change in the future. I would love to see them do that. SoFi is a profitable business now. You mentioned recession is definitely a risk. Management thinks they are going to be much, much more profitable in a couple of years. They're predicting earnings per share that GAAP earnings, not adjusted, in the 55 cent to 80 cent per share ballpark, which means it's trading at a single-digit multiple of 2026 earnings. If they could achieve that, the stock will be successful. That's still an if at this point. We'll be totally fair. It's one of my favorite stocks to watch. It's not a giant investment for me, but it's one of my favorites to keep an eye on. And it's one that I think is a buy right now, especially at the current price. But again, it's not the lowest risk bank stock you'll find.
I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investment, so I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market by more than 4 times, so go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 650% as of April 16th, 2024, and are measured against the S&P 500 returns of 148% as of April 16th, 2024.